Test, test, 1, 2, test, 1, 2, 3, test, test. Testing, 1, 2, 3, test. Testing, test. You happy?
Oh gosh. Yeah, Good morning, everybody. The November 1, 2016 School Land Board meeting will come to order. Hopefully everyone has recovered from last night's Halloween experience. Before we begin today's agenda, I wanted to welcome Augustine Hernandez and Deborah Lancaster, who are both landmen with Charger Shale Oil Company based in Midland, Texas. Thank you for coming in. We love having visitors. Please spread the word far and wide in Midland that you're always welcome. First item on the agenda is number 1, and that is the approval of our minutes from our last meeting, October 4, 2016 School Land Board meeting. After the board has had a chance to review the minutes and assuming no questions, comments, I could entertain a motion to confirm those minutes.
A motion?
Second. Motion is made, seconded, and carried unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda as posted. And after the board has had a chance to review a copy of the consent agenda and assuming no questions, comments, concerns, I could entertain a motion to approve the consent agenda.
So moved. Second.
Motion is made, seconded, and carried unanimously to approve item number 2. Items number 3 and 4 will be held in executive session. We will enter into session pursuant to Chapter 551, Subchapter D, Section 551, Tech 071 of the Texas Government Code for discussion and consideration regarding pending or contemplated litigation and or settlement offers, or to seek or receive advice or counsel related to items 3 and 4 on the docket. And subsection 551, Tech 072 for the discussion and consideration concerning purchase, sale, exchange, lease, or value of real property related to items 3 and 4 on the docket. Following executive session, we will reconvene in open session to complete the agenda. The open session of the November 1, 2016 School Land Board meeting will now resume with item number 3.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. Approval of this agenda item will constitute the approval of an investment by the General Land Office on behalf of the Permanent School Fund in NCAP Energy Capital Fund 11 LP. The IEC is recommending that TexGlow invest $300 million on behalf of the PSF in NCAP 11. NCAP 11 is expected to be a $6.5 billion commingled closed-end investment fund that will focus on providing growth capital to the independent upstream sector of the North American oil and gas industry. Details surrounding the sizing, timing, and strategy of NCAP 11 were discussed by investment management staff with principals of the fund sponsor, Houston-based NCAP Investments LP, several times over the past few months. In addition, NCAP furnished investment management staff and the Townsend Group with comprehensive due diligence materials, and NCAP principals made a detailed presentation to the IEC and Townsend on NCAP 11 on October 24th of this year. In conjunction with that ongoing discussion, review, and analysis, staff worked with Townsend and legal counsel to ensure that the investment fits within the framework of the TexGlow Permanent School Fund Real Assets Investment Policy Statement and is in the best interest of the Permanent School Fund. Therefore, the IEC is recommending that you approve the investment of $300 million in NCAP Energy Capital Fund 11 LP, and I'm happy to answer any questions.
So moved.
I'll go ahead and second that. Motion is made and seconded with 1 abstention.
And for the record, we would like to note that School Land Board member Mr. Burciaga has on file a recusal memo regarding agenda item number 3 that identified a potential conflict, and he has officially recused himself from both voting and discussion on item number 3.
Thank you for that, Council. Next item on the agenda is number 4 stated.
Thank you, Mr. Chairman. Members, approval of this item would constitute your approval of an investment by TexGlow on behalf of the Permanent School Fund in Macquarie Infrastructure Partners 4 LP. The IEC is recommending that you invest $200 million on behalf of the Permanent School Fund in MIP 4. MIP 4 will be a $3.5 billion commingled closed-end investment fund that's focused on investing in a diversified portfolio of infrastructure assets located primarily in the U.S. and Canada. The fund will target investments that offer essential services to communities and that provide sustainable, predictable, long-term cash flows. In addition to providing comprehensive due diligence materials to investment management staff in the Townsend Group, Macquarie representatives discussed the details and expected timing of MIP4 with investment management staff over the past several months and made a detailed presentation to the IAC on MIP4 on October 24th. In conjunction with this discussion, review, and analysis, investment management staff worked with legal counsel in Townsend to ensure that the proposed investment fits within the framework of the TexGlo PSF Real Assets Investment Policy Statement and is in the best interest of the Permanent School Fund. Therefore, the IAC recommends that you approve the investment of $200 million in Macquarie Infrastructure Partners 4 LP, and I'm happy to answer any questions.
Questions from the board?
So moved. Second.
Motion is made, seconded, and carried unanimously to approve item number 4. Next item on the agenda is number 5 stated.
Thank you, Mr. Chairman. Members, this is a non-action item. I'm pleased to present you with a quarterly investment report of the TexGlo Permanent School Fund Real Assets Investment Portfolio for the period April 1 through June 30. The performance measurement calculations and all statistical data presented in the report were prepared by State Street Bank and its Private Edge Group, which are the custodial accounting and performance measurement agents for the portfolio. It's a brief market summary. The second quarter U.S. GDP increased at an annual rate of 1.4% after increasing 0.8% in the first quarter. Current consensus indicates an expected annual GDP growth of 2% for all of 2016. That is pretty much on target right now. Also during the period, the unemployment rate decreased to 4.9%, down from 5% in the first quarter of 2016. Fed policy was unchanged during the quarter. The Fed left its Fed funds rate target range at 0.25 to 0.50. This was based upon their view that although there was further improvement in the U.S. labor market conditions during the quarter, expectations are that inflation will continue to push towards their 2% target. They also expect economic conditions will evolve in a manner that warrants only gradual increases in the Fed funds rate. Thus, the Fed funds rate will probably remain below levels that are expected to prevail in the long run. With regard to the real estate market, the U.S. commercial real estate market is measured by NPI, returned 2.03% for the quarter. Its trailing one-year return was 10.98%. All of the quarterly individual sector returns were positive for the 25th time since the second quarter of 2008. Industrial and retail were the best performing sectors. Hotel brought up the rear. The returns for the sectors during second quarter were hotel 1.46%, retail 2.17%, apartment 1.88%, industrial 2.90%, and office 1.74%. Another strong quarter from real estate. In the energy markets, WTI oil prices were still volatile. They fluctuated between $45 and $50 a barrel for most of the period, and they ended up about 31% for the period at $48.33 a barrel. Prices were supported by several factors, including ongoing disruptions in Nigerian production, potential disruptions in Venezuelan production, continued declines in U.S. supply, and wildfires in Western Canada. The total U.S. oil production was down about 10% year over year to around 8.6 million barrels per day. Even though the IEA recently predicted that non-OPEC supply would decrease by approximately 0.9 million barrels per day during 2016, most analysts believe prices will be range-bound for the remainder of the year, mainly due to slower economic growth due to the Brexit vote and also because Nigerian production would be coming back online at some point. Natural gas prices finished the quarter also on a bang at $2.94 per million BTUs. That was up over 48% for the period. That was caused by a tightening of supply and demand as gas production finally began to decline and warm weather spurred an early start to the air conditioning season. Most analysts expect that rising industrial demand, LNG exports, and continued coal to gas switching is going to push prices to $3.50 per million BTUs by mid-2017. We will see if that happens. I think three is a good number. Somewhere between 3 and 350 is a good number. 350, we'll see. As far as the portfolio is concerned, if you'll turn to the performance tab in your book, I'll go through the numbers for you. The performance measurement tab, the numbers were quite good for the quarter. Total NAV of the portfolio, including cash equivalents, was $4.933 billion. At the end of the period, the external portfolio was $2.522 billion, which is about 51% of that number. The internal portfolio was at $242 million, which is a little less than 5%. Regarding the external portfolio, if you look at the first line there, current quarter performed 4.01%. That's versus a benchmark of 2.11%, so 190 basis points above the benchmark. The real estate sector of the portfolio was up 2% for the quarter. The infrastructure was up 1.3%, but the energy sector had a big write-up. It was up substantially at 10.28% for the quarter. Of course, that was due to a significant rally that I described in oil and gas commodity prices during the quarter. For the 1-year, 3-year, and 5-year periods, the external portfolio was at 10.45% versus 8.16 on the benchmark, so a 229 basis point margin over the benchmark. The 3-year return was 13.28% versus 9.25 on the benchmark. That's an outperformance by 403 basis points. And the 5-year return, a very strong 15.43% versus 9.8 on the benchmark, so outperformance there of 563 basis points. At the end of the period, about 36% of our total existing capital commitments remained unfunded, 24% of real estate, 41% of infrastructure, and 46% of energy were unfunded at that period. The internal portfolio had a negative 1.19% return during the period compared to 2.03% return on NPI. That was approximately 322 basis points below the benchmark. The 1-year return was 10.35% versus 10.98 on NPI, so about 63 basis points below the benchmark. That was the first negative return on the internal portfolio after 21 consecutive quarters of positive returns. On a combined basis, the portfolio without cash generated a 3.52% return versus 2.11 on the benchmark. For the 1-year return, 10.58 versus 8.16 on the 3-year, and 12.78 versus 9.25 on the 5-year. As far as diversification is concerned, still generally over-allocated to real estate based on purely an investment basis at 46% versus a target of 33%, but that will continue to change over time as more of the commitments to infrastructure and energy are funded. And for example, at the end of the period, the real estate allocation on an invested plus unfunded commitments basis was 38%, infrastructure was 26%, and energy was 36%. So very nearly in line with targets that are in the investment policy statement, and expect that by the end of first quarter next year, we will be right on target with all of those allocations. The combined portfolio, as far as geographic diversification is concerned, the allocation to the U.S. is 83% of the portfolio compared to a target of 75%. The international allocation is about 7% compared to a target of 10%, and the allocation to Texas is 10% compared to a target of 15%. Again, this is a non-voting item, informational only, but I'm happy to answer any questions you may have.
Any questions at this time?
No, thank you.
This being a non-voting item and there being no further questions or business before the school land board meeting, this meeting is hereby adjourned.